we've been hearing about this crash for a long time. Nothing has happened, especially in the markets where the fundamentals are strong. You're looking at job growth, you're looking at population growth, you're looking at employment growth. Those are the fundamentals, right? The demand drivers are there. Even if the market slows down a little bit, as we all know, market will come back roaring, right? It's only a matter of time. So you just have to play the game, take some chances, and hope for the best.
Very excited now to bring up Joseph James. Joseph is a commercial real estate coach and founder of ROI Muse, which provides tools, training, and coaching for commercial real estate brokers and multifamily investors. He and his team of coaches and consultants have trained over 2,000 agents and brokers in commercial real estate. Joseph, welcome to Real Estate Hacking Live.
What's going on, Joseph?
Thank you, Chris. Well, thanks for having me again. Always love
Absolutely.
coming here and chat with you.
Yeah, I just noticed our little names aren't below our boxes anymore. I don't know, Ben, if you have a chance to see what setting that is. But anyway, Joseph, so you're a commercial broker. You do a lot of training for other commercial brokers and agents and operators. So what are you seeing, having a good pulse on the active players in the market? What are you seeing on how folks are using real estate to beat inflation?
I think the message is being clear, right? So get ready because there'll be a harvest down the road, right? So because things are slowing down, a lot of properties are coming for refinance in the next 18, 24 months. And, we'll have to wait and see how the market plays out. But I think what we are doing as brokers and investors is to be prepared, right? Cash is king, as we all know, and try to, get your funding sources aligned, right? So get your funding sources available so that, we can, go after those deals when they become available. I mean, I think pretty much everybody agrees that, there will be some opportunity in the next year, 2 year for, taking down some deals, but, lending will be tough, right? Financing is going to be hard. And
yeah, you can't. It's funny how people say it's like so easy to get a loan, but then it's hard to get a deal. And then it's the opposite. And people are like, "Man, I just wish there were more deals." But typically, when there are more deals, it's harder to get the financing. People forget that. So you've got a little bit of a different take. I mean, everyone seems to be on the same page, as in opportunities are becoming more available just as the economy softens and the market softens. But so cash and king can also be a double-edged sword, where if you just sit out waiting for the next great crash, you're losing it to inflation. How do you balance that dichotomy?
Well, I think, the way we are doing it is we're looking at big equity, right? So, we are actually investing. We actually have a property under contract right now. We're trying to close that in December, right? So it's a 400 unit property in Fort Worth. So we are active and our investors are active. I know there is a little bit more challenge than compared to, 6 months ago, 12 months ago, but
so it's being, let me see if this helps. It's being actively patient. Like you're out there in the trenches while also being really patient on deal selection and looking at the fundamentals, not necessarily jumping on everything. Is that?
That's absolutely right. We are only looking at properties where there's a delta between the current rent and the current property rent of the market rents and the current rent of the property, right? So if there's no significant delta, we're not even going after them. That is our risk mitigation, right? Even if the market goes down, we know these properties, we can, there's enough room to value add. Yeah. There's enough room to increase the rents. So, and then, we'll hope for the best, right? Because we can't predict the future, but we know that we are more protected than, like your previous guest said, right? Class A assets, more risky because you're paying a premium, not much upside. And we know, already the rent growth is going to be slowing down compared to the previous years. So that's going to happen.
And they're not going to go up 20% year over year and forever.
Yeah. And if you look at the inventory that's coming online, that is the scarier part for me, right? You can see Dallas, Fort Worth, for example, 30,000 new units coming in when the absorption rate was, 11,000 last year, right? So, you have more inventory coming in. That's going to definitely put some price pressure.
That's one thing I've noticed with single residential construction has pulled back, but that's mostly been the single family side. Multifamily has been now it's still behind, but it's been catching up. COVID took a couple steps back there, but there's a lot of new planned and proposed.
That is the number you have to keep an eye on. If you are active in the market, keep an eye on the inventory that's coming on board, what's under construction. And
because the value add does give you insulation because you've got a basis and you've got a gap that you can bridge, but it's still very much a concern to know the inventory of the market and the absorption rate, because everything collapses down. When Class A can't get their target rents, they'll drop it. And at some point, an extra $100 to go from a B to an A, I mean, you just do it.
You do it and people move in together, right? People move in with their families, or, people get roommates or whatever that's what happens when the economy is down, right?
Which is shrinking. So that's shrinking family units. And I read that in Brian Burke's book when he was talking about population's increasing, or everyone needs homes, but that's true. Everyone needs a home, but there can be fewer homes needed if people just decide to consolidate housing units. Because I read a stat recently where the new family unit starts were down. Meaning they're either staying there. They're not multiplying. I guess kids, I don't know, maybe the kids are just staying home or what, but
I think the multifamily guys are looking at this as, okay, now my risk is lower because housing is got that much less affordable, right? Mm-hmm. So not many people are buying new homes, so there are more renters in the market, right? So even if there's some of the collapse or some of the people moving in phenomenon, you still have a lot more renters. But yeah, I think, like I said, I don't have any crystal ball. I don't think anybody knows. We are all speculating what's going to happen. We've been hearing about this clash for a long time. Nothing has happened, so we hope this continues to grow, especially in the markets where the fundamentals are strong. Mm-hmm. So you're looking at fundamentals, you're looking at job growth, you're looking at population growth, you're looking at employment growth. Those are the fundamentals, right? So if the demand drivers are there, even if the market slows down a little bit, as we all know, market will come back roaring, right? It's only a matter of time. So you just have to play the game, take some chances, and and hope for the best.
So
risk by buying it right? We all heard this, right? You can buy in any market. You can buy in up market, you can buy in down market, and you can buy in side market, right? So this is more like a side market, in my mind, because it goes up market for a long time, right? So you can buy in any market if your product is, that based on what kind of product you're looking for, right? As investors, we're looking for the ones that we know there is less risk and we know there's more upside potential. So
smart money. They're you mentioned cash before. Cash is king. So Invitation Homes, they're looking for a $1 billion, a $1 billion JV partner. So anyone out there's got $1 billion, maybe give those guys a call. Blackstone.
That's what I've been doing. I've been meeting with a lot of big equity guys, family offices, equity funds to just line up some funds for future deals, because we all know that that's where the money is going to come from, mostly from big equity.
Correct, and especially if the stock market continues to be volatile, but private equity has had a huge rise over the last 10 years anyway, and it's they're expecting that, I forget if it was like double or almost triple over the next few years, unless the SEC starts to throw some wrenches in that growth. But we'll see. Is there anything from a limited partner and passive investors that you're seeing, concerns that they're having, or maybe something they're looking for that's a little bit different than what they've been looking for over the last couple of years?
No, I think the new investors, the first-time limited partners, they're all sitting on the side, right? They're waiting and see what's going to happen because they can't pull the trigger because this is their first deal, and that's very understandable, right? There's a lot of nervousness about the market and so forth. I think the people that are savvy investors, that they've gone through a few cycles, they know this is a long-term play. They know that you're not going to make a home run in every deal, but it's better than money sitting idle and losing value, right? So 8% inflation, your money is $100,000 sitting in the bank is worth $93,000 in a year. So you're losing money. So even if you're not getting the appreciation like we are getting usually, at least you can prevent the loss. Plus, you have all the tax benefits and the other benefits as well. Plus, if the property appreciates, then you're going to come up much way ahead, right? So, especially in inflation, the rents are going up. As long as the rents are going up, it's not going to go up 10-15% like it used to be, right?
Yeah.
But even if you get 3, 4, 5% rent growth, I think the Dallas market has a 6% growth or something and projected 5% growth. So it's still much better than losing 8% sitting in the
100%. That's why I've always liked real estate. It's an inflation hedge plus cash flow plus appreciation over time plus from a long-term perspective, you can have equity build up through debt pay down. And then the tax benefits, which if you're a real estate professional, which you are, I am, folks that are doing this full time, there's a lot of benefits. So, well, thank you very much, Joseph. It was a pleasure having you on.
Yeah, thanks for having me.
Absolutely. Talk to you soon.